Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Welcome to another episode of the Tech Behind FinTech. I'm joined by my guest, Ryan Rosett from Credibly. Ryan, how are you doing today?
I'm great. Thanks, Andy, for having me on your podcast. I appreciate it.
All right, man. It's all good. Listen, before we get started, let's do some housekeeping. We are streaming live from Facebook, LinkedIn, YouTube. We also have a separate stream going from Instagram. So that is the housekeeping that we do every week, just letting people know. But we're going to get into the show now. So today's topic, I'm really excited to talk about it. Ryan's a fellow former real estate guy, so we're going to have a good conversation about that. But the show title, No Bank, No Problem, the New Age of Small Business Loans. So I want to get started by introducing Ryan to our audience. So I'm going to read his bio, and then we're going to get into today's show. Ryan Rosett is the founder and co-chief executive officer of Credibly. Ryan co-founded the company in the aftermath of the 2008 financial crisis after recognizing the immense need for financial assistance and saw an opportunity to make a big difference for small and medium-sized business owners. This inspired Ryan to do a complete 360 in his career, from real estate development to fintech. Under Ryan's leadership, Credibly has spent the last several years developing groundbreaking new ways to make small business financing faster, easier, and more accessible to small business owners using machine learning and generative AI. Wow, man, it's pretty cool.
Makes me sound okay, right? That anyone can write a good bio. So
I think it makes you sound more than okay, man. Sound like a superhero saving small businesses, man. So let's get into it. Let's take let's rewind, right? So I want to get into 08 and that time period. I want to know what you were doing during 08. I'll tell you what I was doing during 08, 07. And from there, let's paint the picture and get into the topic. So
yeah. Again, thank you again. Yeah, thanks again for having me on. I started my career in real estate. So I'm a lawyer by education. I never practiced law. I used it in real estate. I was in real estate development for 15 years. I'm from Detroit, or just the suburbs of Detroit. I've grown up here. This is where I work, and this is where headquarters is. When I was in real estate, some of you who are listening will recall that in 2006, 2007, Michigan was in what was called a single state recession. And it was just, very impacted by the automotive industry and, everything that was going around. And so what happened in, and they say, I think when Michigan has a cold, or when Michigan has a flu, the rest of the country has a cold, or whatever the case may be, it was a really early sort of indicator as to like what the economy was going to do. Then the rest of the country obviously fell into this, what was the Great Recession. And my profession at the time was land development. So what I did was I would identify land development opportunities. I would either control it via a contract or acquire it, go through the entitlement process, and then either sell it to national home builders or sell it to commercial like big box. So like Walmart and, companies like that. And that profession quickly became something that was no longer a profession. So like it was, there was no such thing as land development. It was, probably the worst asset class you could possibly be in. It was like non-income producing. It cost money to own. There was just nothing, and there was no way to sort of get out of it. I moved from there into bridge lending. So then I was seeing, like, as banks were over leveraged on certain income producing properties, we were providing bridge capital to the customers in order to buy the assets back at a discount. So if you owned an asset in an apartment building and it was over leveraged and the bank, saw it and was like, oh no, I don't want this asset because it's going to affect my capital ratios as a bank, we would provide, and they would sell it to them at some discount to whatever their loan note was. We would provide the capital for them to buy the asset back at, a 1 year, 2 year note, at a 50% loan to value. So like that was like the impetus of like moving into what I do today.
So let's it's a lot to unpack, right? So let's take a step back, right? It's '08, you're doing land development. How did you get into land development?
So I worked so I started my career working for a regional land development firm based in Michigan. They were doing large scale master plan communities. So I worked there for 5 years, learned the trade, and then sort of went out on my own to do it myself.
Okay, so now you're doing land development for, you because I like what you said earlier. You said that you're by trade, you're a lawyer, but you never practiced law. You just went into the development aspect, right? So you worked at this company, got the skill set, then you branched off on your own. You have your own land development company. You're buying, these huge, plots of commercial real estate. When you buy it, do you hold it or do you do some sort of development on it before selling it to the Walmarts or the home builders?
So what we were doing is largely entitlement. So we would do horizontal development. So like, for example, we put sewer, water, roads in, but typically it wasn't vertical. So, make it pad ready. So, a builder could go in, put a shovel in the ground and start building. That's kind of like what we did. Or we'd have fully detailed engineered plans done, and maybe a national home builder would just buy the package and say, hey, we'll develop it. We'll buy the paper lots, and and go through the development process and put the sewer, water, roads in themselves and control the entire process.
Okay, so you'll make some sort of improvements or package it for the larger developer. That was like a flip. You get the land for a certain amount of price, obviously cheap, and then you do some work on it to make it build ready, vertical build ready, and then you'll flip it over to either a home builder or a commercial vendor. Is that accurate?
Correct. Yeah, and it was mostly like the creating the value was through entitlements, zoning. So like either rezoning the property or getting a site plan approved or doing a PUD, plan unit development, or master plan development, something creating a little bit different value from just the parcel that may have been zoned agriculture or may have been zoned residential one, when, maybe you can get multifamily on it.
And when you were going through that process, I would assume you needed loans to accomplish this. So you were working on the other end, working with certain lenders and banks to get the loan to acquire it, also to the entitlement, because the entitlement process I know could be extremely expensive, just going through that, time and costly in terms of the paperwork and dealing with the local community and so forth.
Yep, that's right. So like if we controlled the property, oftentimes like the best option would be that we would have an option on the property that we would take a certain amount of time. We would pay the seller a certain dollar amount for the right to work on the property and try to entitle it, try to create more value. And with that, then once we obtained the entitlements through the local municipality, we would then close on the real estate. So, and it would be much easier from a financing standpoint that if we had the entitlements in place, we created the value, banks or financing vehicles would say, oh, I see that, like that a lot of value was created. But the soft costs of going through the entitlement process, we funded ourselves.
I got you. Okay. So obviously business is going well at that point. And at what point, because you mentioned that, this is the first time I even heard about the single state recession. I mean, during that time period, I was in the New York area. I was working for an investment bank at the time, and ironically, we were building the platform that we were working on was around credit default swaps, right? How ironic. So that's a whole other story. So I got it from both ends because on the side I had some a real estate portfolio at the time I was working on. So, you're doing this is because it's obviously lucrative at a certain point. What year did it like, oh my God, this business is just drying up? Was it '07? Was it '08? Like what year was that?
Oh, for me, '06 was like a year where I realized that the real estate in metropolitan Detroit was a very difficult market to be in. And and if you go back in time and you look at what was going on, and I talk about the single state recession there, I haven't looked at this in a long time because it was it'll bring up like bad dreams for me. But that was a period of time when there was this like single state recession, and then the entire country sort of followed suit.
Got it. No, I just want to paint the picture here because I like the way it's always interesting to look at the end result, and you're finding, what brought the person there, the idea, and how they now impacting in terms of the small business lending. All right. So you saw that during '06. I know offline you mentioned that was before the gray hairs formed,
That's right.
So
That's right. I had dark hair on my face before then. This was dark, so a lot
you
more
know
hair.
what's ironic about it now? Like the Detroit real estate market is really picked up because there was a time, just for me being in the game, even though I'm more in the East Coast, a lot of East Coast people were going out there and buying like cheap properties in Detroit. And now in 2025, you see like in the city, like a lot of the condos picked up, a lot of the homes, everything turned around. So that's another conversation. Well, we might add into that, but I don't want to dive too deep into that. That was an observation that I noticed. All right. So you see in '06, '07, oh my God, the rest of the country really got hit in '07, '08. Then it just got catastrophic, right? But prior to that, because you were in a single state recession, you got that impact like 2 years earlier before the rest of the country got the impact, right?
Yep. So what I did, what I did at that time was I looked in different markets that I thought were more emerging, more recession proof, and identified a few different areas that I wanted to focus on outside of Detroit for land development, believing that maybe listen, I'm not an economist. We all have had lessons in economy given sort of what's going on in today, and tariffs and things like that. But like in back then, I would say I was, I didn't know if it was contained to Michigan or if it was going to spread, but I figured, hey, let me, continue with what I've been doing for 15 years. And I took that to markets like Charleston, South Carolina, Myrtle Beach, sort of coastal areas that were experiencing like much higher growth rate and population influx than Detroit, which was at the time, Detroit was still, seeing population decline. So, that's what, and, but it didn't matter. I couldn't run away from the problem. I mean, the problem was like very macro, and it caught up everywhere, as we all know that it was a 50-state issue.
Yeah, I mean, lending totally dried up at that point. It wasn't even.
Yeah.
Like
Yeah.
it just was dry. It was.
No money.
Yeah, it was a really interesting time period in my life. I'm sure others were severely impacted as well. So how then did you transition into bridge lending, right? So you obviously say, okay, you know what, we're in Detroit, the land, this land thing isn't really working here. Let me take my show on the road. Wow, on the road, still not working. How did that transition to bridge lending happen?
So it was sort of a natural progression from I had some friends in metropolitan Detroit that were in the bridge lending business. I had certain expertise that they didn't, and so I joined the company as a partner. It was a small fund, but we were able to get a lot of stuff done, and it was an interesting time just because there was like a ton of where you're coming out of, when you're in real estate, and in a world where the banks were very much holding a lot of assets but not lending, and trying to sort of purge to sort of right size their balance sheet. We had capital and we were deploying it to developers who were able to negotiate better terms from the banks because the banks were doing discounted payoffs. So it was sort of a natural and we were closing in 30 days. And like real like a 30-day close is lightning fast. By the time you document mortgages and perfect it and things like that nature. So it was a very fast process, which is the transition that took me to the business that I'm currently in at Credibly, and started, which is moving from a business of land development, which takes, I would say, 2 to 4 years to get a project entitled and fully engineered and, I'll call it shovel ready, to something that takes 30 days to something that we are approving and funding same day. So I went from, I guess I have a need for speed, and I started in a business that was as slow as it gets to a business that, is now using all types of automation and generative AI and really making decisions, very quickly.
So I see a pattern, right, in your story, in a sense that you go into these businesses that you might not have experience in, you work it for a while with other people or for someone, you get that level of expertise, then you branch off and do your own thing. Is that pattern pretty much?
Yeah, I mean, I think so. I mean, I would just say that I'd say I started my career that way. Then, I would say I moved into bridge lending as a preserving what I've learned over the course of 15 years, and exercising that and applying it in what I would say was a useful way to make money. And then, but then I don't know that what I do today is akin to lending to real estate. I think that's a much discipline. This is, and again, I've never been a small business lender up until I started this business in 2010. So, and learned it, but the discipline behind lending to small businesses is very different than, real estate. We're an unsecured lender. We're not attaching to an endpoint. So it's, we're profiling the applicant, we're profiling the business, we're profiling the cash flow of the business, we're profiling the web presence of the business, and all the activity that surrounds it, and then have a proprietary scoring model that then sort of gives it its probability of default, and and then we do a risk adjusted offer based on the risk profile of that customer. So I maybe things I've done in the past prepared me for what I'm doing today, but I would say that what I'm doing now is a would be a very different challenge than what I was doing in the real estate side. And times have changed so much. I mean, when I started, I think I was the first one in my office that had a computer. Everyone else was operating with a phone on their desk. So I mean, and I'm older, but I'm not that old. So I mean, I'm just giving you the sense of when it was the mid '90s, certain people just weren't on their computer. It was just wasn't it, that was I think those were the days of, I don't know when AOL was out, but that was probably AOL time, where you were in this little kind of portal environment, and you were able to check the weather, so.
No, definitely remember those times, around 97, 98,
Yeah.
the AOL and the modem and connecting.
Exactly.
Yeah. So how did that transition work then, from the bridge lending over to small business lending? Because how did that process work?
So there was a huge learning curve. So I have a partner in Credibly, and we had private equity. We've done a management buyout. We've sort of, over the 14 years of growing the business, we've gone through a lot of different twists and turns. And I would say and then you want to throw COVID in there just to throw a little bit, that felt very similar to 2007, the Great Recession, and and then you have today, which puts a whole different set of issues, with tariffs and things of that nature, and as to how that may affect our portfolio. But just back to your question in terms of how I transitioned, it felt pretty natural. It felt like coming out of the Great Recession, banks really kind of contracted, and were just, licking their wounds from the fallout from the real estate, and they were not entering small business lending anytime soon. And just to give you a little context of what we do, we provide working capital to small businesses. It's generally a 1-year term on average. We go out to 2 years. It's our average loan size is around $65,000. And if you think about it from a bank's perspective, banks aren't equipped to lend $65,000 to a customer. It's just like not enough. And so the amount of time that it would take a bank to underwrite a $65,000 loan, go through the loan committee, the credit committee, have everything in place to it would take 90 days if you get approved. And they're just not equipped to do $65,000 loans. They might do a consumer loan or something like that, but not a small business loan. So like the banks typically, like when there's a time when they're struck with some like adverse economic impact, they usually pull back and they're slower to enter that business division quickly. They're just like they just kind of move a little bit slower than certainly we do. And that's the opportunity. That's how Credibly was sort of founded, is just like through like the banks of the world just not lending to small businesses, and the need for small businesses to access credit, and they were starving for it. And so that really was the start of our business. And when we opened, we really didn't know what we were doing. We learned. So, and we were looking at bank statements, we were trying to figure out the underwrite, but we made mistakes, and there's no doubt. But we learned a lot. We quickly upon starting the business, we did a joint venture with a bank, where the bank was providing us the capital, and we would originate, we would underwrite, we would fund, we would table fund it, we would service it, and then we would sell the paper to this joint venture entity of which we were a partner with, the bank. And then it sat on the bank's balance sheet. And I want to say, in the world of fintech, I think we probably were the first true fintech partnership with a bank. Because this goes back to 2011. And it worked really well. We grew the relationship through 2014. The bank was earning, banks typically like measure their return. They do ROAA, return on average assets. Their return on average assets was around 13%. Typical bank, like Bank of America, kind of hovers at like a 1%. I think like specialty banks might be 2 or 3%. But like they were getting like oversized returns from a relationship. And we grew the relationship to a point where we sort of outgrew the bank, and they asked us to remove them or take them out, and gave us a year. We secured a senior credit facility from another bank. We needed to bring in equity, so we brought in a private equity partner. And we did a simultaneous close where the private equity firm came in, funded the business with equity, and then we took out the bank partner that we had with our senior credit facility. Then we brought in like a much bigger bank, Truist, which was SunTrust at the time, which is who we currently do business with.
So a lot of that, right? So the first question I have: how did you get to that sweet spot of 65,000? Because is that the maximum lending you would give to a small business?
No, so we do up to 600,000. And so I'm just giving you like our average. So we'll do 5,000 to 600,000, and our average loan is 65. It's just the math. I would say we do a ton of 40s, 50s, 60s, 70s, 80s, 90s, and 100s. And then it's sort of a bell curve a little bit in terms of like what we do. I would say between 40 to 80,000 is sort of our sweet spot.
Right. And then the small business has a 1 to 2 year time period for the loan.
Correct.
Okay.
Yep.
You mentioned that, early on you made a lot of mistakes. Can we talk through like one of the biggest ones?
Um, yeah, I mean, there were some mistakes that we were dealing with, certain uh there's there's a broker network that exists in our business. And I'll kind of compare them to like a home mortgage, uh, kind of like shop, that may have a group of 10 individuals that are, calling on, for us, small businesses, but for like a mortgage shop, it would be calling on, potential home buyers. And so, so these mortgage, or I'm sorry, these small business brokers are, we went a little too long early on with like a one broker that was, you know, was committing some fraud with us. So, that was a lesson we learned. And but the it was like it was managed, and it was a controllable uh uh like issue. It wasn't too pervasive. Our portfolio wasn't big enough, so we were very on top of it. Now we have all types of tracking mechanisms in place in terms of performance, and we look at tons of different metrics associated with anybody that we do business with. Whether it's a referral partner, or we have a direct sales team, but like every channel is analyzed separately, and we look at, is there anything off with the performance metrics associated with it, the conversion metrics? So we just want to make sure that we're being treated fairly with our customer. And our
No,
customers could be a small business. It could be a small business, or it could be a broker. So,
no, I got it. I mean, makes sense. I'm always fascinated and curious when founders say, you know what, when we first started this business, we didn't really know too much about it. We knew that it was an opportunity, but we didn't really know the nuts and bolts. And just getting over the unknown and proceeding forward, I have a lot of respect for. And I just want to understand like the mindset behind that, just for the audience, right? Because obviously we're like literally at that time, the economy's still crazy. We're coming out of it, right? So it's a lot of risk involved. You're going, you see an opportunity, yes, right? Banks are not lending to small businesses, but from a risk perspective, there's a reason why, right? And like you said before, when you were doing the bridge lending, it was tied to an asset. Now it's unsecured. So I mean, it's nothing for someone. I mean, sometimes with these loans from to an LLC, it doesn't even show up in your credit report. So you know, somebody could just take your money and literally not pay you back and just close shop. So all these different variables, right? How did you overcome, especially being in the business for as long as you have, for 14 years?
so we did a lot of due diligence, and it was all manual. And it was like, we weren't using a bunch of tech products that we, currently leverage. And we, I think we made some, good decisions like through the process. We hired some good underwriters. And we really just, continue to learn. And like any business that you start, there's risk, so you have to be willing to accept that what you're stepping into has risk. And we think we were pricing for the risk. And so that in the event that there was a default, we would still be protected just from the amount of what we were charging at the time. And things have changed over the years, that from a competitive standpoint and pricing and adverse selection, like we do today. We have a far more sophisticated approach to our underwriting and pricing. So for example, if you're a customer that's been in business for 10 years, you have a 780 or a 780 FICO, your cash flow is strong, your average daily balance is strong, you have no NSFs, you have no negative days in the bank, there's no impairments like on your credit, you're going to get really good pricing from us. Then to the opposite, you have somebody who, has a 650 FICO and, kind of runs his business a little differently where, does have a few negative days in the bank on a month, bounces a few checks here and there, runs late every once in a while on their mortgage payment or whatever the case may be. That's going to be priced different. So that's going to have a different risk profile for us then. And that's all automated in terms of how we approach that. So it's, from when we started, that didn't exist, like it was like one price for, doesn't matter who you are, like you're a doctor, you're going to get this price. You're a plumber that's been in business six months, you're going to get the same price. And that's unfair. It was like, and, but that's what we did when we started because that's all we knew. And we didn't have the ability to have like dynamic pricing. And, today we do.
No, I want to get into that. Let me always try to give an audience member shout outs when they comment. So my man, Kevin Garland, keep on crushing it, Andy. Thank you very much. Appreciate you and appreciate you watching the show. So, let's get into that, right? Because that's innovation, right? You have a situation you started, it was more manual with the due diligence aspect. And you mentioned, right, bringing on an underwriter to help with that risk process. For those that don't know, because you mentioned a couple of terms, and I just want to just help define it for the audience, right? Underwriter, the origination, just those mortgage terms. Can you just help define it for those who might not be privy to that?
Yeah. So like, for example, like, so I would say our company consists of probably have, 100 plus people that are, on our underwriting team. Okay. Which means that, through the automation, there's, I'll call it like a happy path. And the customer I just explained, which is like a super prime customer, they could maybe fly through our system with fully automated. Okay. But then there's like flags and kickouts that require manual checkpoints, which go to our underwriters for them to validate and that require something like maybe there's our technology is seeing a second owner appear, yet we only have one owner's application. And so then we're going to send out a request to the small business owner and say, we show that XYZ is also an owner of this company. Can you please provide an application for this customer so we can pull them? And then when we pull that information, I'm not saying it's all the time, but it happens. Sometimes they have a criminal background that a customer that's applying to us would not put them on the original application, knowing that their partner has a criminal background that would preclude them from getting a loan. And we find that and then obviously decline the file, or they have a credit that's much, worse, that's going to affect their risk-based pricing. So our underwriters are people that are really just evaluating the merits of the file and then making decisions based on, whether it meets our risk threshold.
Fair enough. When you're in the process now, so obviously you had the one banking partner before you went through and expanded, right? At what point did the innovation happen in which, the manual aspects of underwriting got automated using ML models and machine learning? What point was that?
So I would say our scale changed dramatically in probably 2019. We were running on technology. We were running on a system that we still run on, but it was almost like a monoline underwrite, meaning that it wasn't broken out into individual apps. And so what we did was we built 4 different applications, and we have 4 different departments now that run our underwriting teams, and they sort of run through these underwriting applications doing separate tasks. Many of them we've automated. Some of them still have a manual component to it. And there's and the ones that have manual, we're super busy on automating, and so that we can continue to scale. So like, for example, we went from I would say, reviewing 300 applications a day to reviewing, 1,500 plus applications a day. So, and that would not have worked under our current situation, just the way that it took certain amount of time, because like one person had to do something before the next person did it. Now it sort of flows through the process in a much more seamless way, where it could take, minutes for a task that would take hours, and maybe cost cents versus cost whatever the underwriter's, hourly rate is.
Got it. How, as you start introducing automation and the different technology around AI, how do you avoid bias in lending?
So we have a number of tools built in, because like we also have, so we have an asset-backed securitization, we have bank facilities. So there's redlining, which is a concern based on, which I don't know if you're familiar with or not, but just like like if we didn't want to lend in Detroit for some reason, we felt like Detroit was at risk. Okay. Like we couldn't do that. So from the standpoint, it would be discriminatory based on, maybe it'll be demographics or whatever the case may be. So we have like all these different tools built into our system from a compliance perspective to ensure that there's no bias in what we do. And then we are constantly looking at it to ensure that it's working the way it's intended. So, and that's like a requirement that the banks have on us, as well as like, we impose ourselves.
So it's interesting, but like if we take the example, like if say Credibly was around during '06, as we mentioned, if you talked about the single state recession. So if you're seeing a business that's hypothetically, right, that's coming from a state with a single state recession, as you talked about earlier, would it be redlining not to lend to that environment?
No,
So
it would, no, that would not be the case. Like, so for example, it would be, it would be based on some characteristics that would be discriminatory. So like, for example, we can discriminate against Michigan. Okay. Like, as a lender, we can say like, you know what, like Michigan's like experiencing a lot of economic pain, we're going to like withhold, or we're going to do a much, we're going to cap the loan or whatever the case, we're going to reduce our exposure to Michigan. That's a different criteria than, basically saying, a certain, area in a certain town may be concentrated with a protected class, that we can't do that. That's just like that, and nor would we, but we're not allowed to. So it's but what we can do, and we do, is like if let's just say like trucking, for example. Trucking is an industry that's experienced a lot of turbulence. Okay, just like from COVID to now, with even today, sort of given the tariffs and the supply chain issues, and so we can restrict SIC codes. Okay, and could that impact a driver or somebody who owns a logistics firm who is a minority? Yes. But it's not, but it's that's not to say that it's not also affecting somebody who may not be a protected class too. And and it's even handed against both. So it's not as if we're applying it one way against a minority. So that, like, I'm just giving you an example of like how we may restrict industries. And I'll also say that, for example, where we're like a little unique also is that like where the wildfires in California, we adapt really quickly. So like when we know that there's fires going on, we look at like what's coming in on the funding side and what's going to fund that day. We can do an instant site inspection. So we have a firm that we use that we send out a text. It pops open it goes to their cell phone. It pops open to their camera. It asks them a question. Please take a picture of your storefront. They take a picture of their storefront. Please take a picture of your credit card machine. Take a picture of your inventory. Whatever the case, whatever we're asking. and they take 5-6 pictures. It gets uploaded into a report. It comes back to us in minutes. It's that's an example of like, we want to ensure we can't lend to a business that potentially is impacted or burnt down. That would be silly. I mean, so the source of revenue that's going to pay us back doesn't exist anymore potentially. So like, those are examples where we quickly react when there's like natural disasters and make changes like very quickly. So just to ensure that the businesses that we're lending to are still in business.
What are some of the biggest misconceptions around small business lending that you've seen?
I think small businesses, and everyone says it, they're super resilient. They seem to find a way. I want to say 50% of the economy is sort of based in small businesses and small businesses that employ people in the United States. So I think when they're hit with some issues, they seem to continue to innovate and survive. And it could just be like the human side of us that you do things that are scrappy sometimes, and you figure out how to hustle. And I think that's what small business owners do really well. So I get why banks are scared to lend to small businesses. I mean, we run at a certain default rate, which is higher than a bank would like to see. We factor that into our pricing. I mean, it's just like, that's part of our business. If somebody comes to me, if a good friend comes to me and says, I need a loan, I have a business, I will always say, go to a bank if you first exhaust that. And, but don't be surprised if they decline you or if it takes 90 days. And, that my friend might say, I need money in like 2 weeks. I'll say, okay, that's fine. I can help you, but I just want you to know that our pricing, we borrow from banks too. So it's not as if like we have the same, so we're going to charge more than a bank's going to charge. Obviously we're not a chartered bank. But what we're going to deliver is certainty and speed. So if you're willing to pay for that, that's what we bring. So, you bring us an application, we're going to give you a decision in, depending on if it's a clean application, but certainly within 2 hours. And after that, like, it will fund same day or as quickly as, you want it. So it's really a very seamless process.
Are you akin, like in the real estate business, right? When you're doing development, you can go, you refinance it, it's more of a conventional, but initially a lot of developers, you get a hard money lending, right? And that's extremely expensive, but it's quick. They'll turn around the loan quick so you can make the acquisition and also cover some of the development costs. And, obviously you have to have some skin in the game. Would you compare yourself to, in that analogy, more of a hard money lending aspect to the small business versus going directly to a bank and getting money?
I want to say some people would use that analogy. I don't think it's a fair analogy, and I'll tell you why. Is because there's no one lending to them. So, and there's a reason for it. There's the businesses don't banks aren't doing it for a reason. It's because small businesses, they don't all succeed. And we accept that risk. So when a business goes out of business, we lose money. And if somebody commits fraud on us, we have personal guarantees or springing personal guarantees. So like we pursue that. But if you legitimately take a loan from us, we underwrote it. We believe that it's the business is a good business and make you an offer. You accept the offer. We fund you. Then you go out of business 6 months later. We lose. And that's part of that. That's part of the risk that we take as a business owner running our business. So, and that's why we charge for that risk.
You mentioned default rates are higher in your business versus the banks. What are the average numbers on that in terms of default rates lending to a small business from a conventional bank versus your business?
Yeah, so like we hover in the like 7% range. So on a charge-off basis. So that's like an example of, and we're comfortable with that risk, and we price for it. So that's how our business works. So, it works really well for businesses that are, either one can buy something, for at a discount, where they're saying, hey, wow, I got this great opportunity. I can buy this container of goods, for 50% of the cost that I usually pay. That's an amazing use of capital for us, from our perspective, because like, hey, they're borrowing money. It's, it's cheaper. They're buying something at a discount, and, they win. When you expand your restaurant and you put a patio on it, and so that you can generate more revenue, that's a great use of capital. And so it all depends on, and we ask, our customers before they take the money, how are you using the capital? Oftentimes it's inventory, it's to pay taxes or whatever they say. We have no means of like tracking that per se. So at the end of the day, we ask the questions, we tag it, we monitor that information from a data science perspective, but we're not watching the money go from us to them and them to the IRS or wherever they're sending it to. It's a self-reported information.
Notwithstanding fraud, right? Like you did with the situation you mentioned, right? You went to a business 6-8 months later or whatever, they're out of business. What's the impact now? Because that's a charge off, but what's the impact on the small business owner in terms of their credit, in terms of like payback? Like, how does that work?
And again, I go back to, if they legitimately go out of business, there's no impact from us. Like there's not much there's nothing to get. It's when a small business takes our money with false pretense. So, that's a different story, and so we call that like a bad boy act or whatever, in the world of I think that's a real estate phrase, but like, when they commit fraud, misrepresentation of some sort, that's an issue that springs the guarantee, and we have a personal guarantee on that.
Okay, but if they're legitimately go out of business, it's not going to show up on their credit report, or
no more than their bankruptcy will. You know what I'm saying? Like not from us. Their bankruptcy will show up. That if anyone does a search on them, they're going to see that either one, they filed a 7 or 11, or whatever they filed. If it was a personal bankruptcy, if it was a corporate bankruptcy, if it was a reorg, so yeah, there's no negative credit impact from us.
Got you. What are some things that small businesses can do to increase their chances of getting a favorable loan or getting a loan period?
So, obviously, industry matters. So I don't want to I want to say, how we would treat a business that's been around for time in business is important. A business that's been around for 12 years versus one that's been around for 6 months. Growth trends, like, so revenue trajectories are like something that we look at. So if you're doing, $100,000 a month in January, 110 in February, 120 in March, etc., those are positive trends. We love lending into businesses that are growing. Keeping a fairly, stable amount of average daily balance. So just kind of, watching your cash flow is important. So, monitoring like how you're managing your cash flow. So, because at the end of the day, like, that is how we look at a loan, is we look at the average daily balance. We're cash flow lenders. So as much as like we look at the credit of a customer, it's not, I want to say it's like 40% of our, like overall decisioning is sort of like the profiling the actual customer. The majority of what we look at is cash flow. So is like looking at the bank statement trends. And as I mentioned, like NSFs, meaning that they're bouncing checks, negative days in the bank, meaning that their average daily balance fell below zero. Just normal cash flow, like the way, we all have our own, personal finance, And at the beginning of the month, you need a little bit more cash than in the middle of the month, probably. Your mortgage comes out, your car payments come out, whatever it is that's kind of hitting. So you have to manage for that. So like a small businesses who are, thinking through that have a much better chance of getting more favorable rates from us.
How about like the tax returns? Sometimes small businesses, they underreport on their tax returns to not pay as much taxes. How does that work? And how would that factor in? Because I would assume you need like 2 to 3 years of tax returns from them.
So only files that are seeking over $150,000 do we get a tax return. So
Okay.
all we look at is bank statements. So
Oh,
at the like all we care. That's why I say like cash flow is king for us. It's really like the but larger deals, we want to make sure that they're filing. We also want to make sure that because there's more exposure on our side, that the owners are the owners, and if there's K1s, who are the K1s going to, just tying out like so that we make sure that we have the owners. Because that's an important piece of what we do is that making sure that we're lending to the person who claims that we're lending that made the application.
I got it. I got it. The next question, right? I would, because you've been in business so long, I would assume you have like repeat customers that, like with the scenario you mentioned, I can get a huge discount on if I buy this bulk shipment right now. And then they come back to you. Do you see a lot of that?
We do. It's a big part of our business. So, we call it engagement or renewals. It's a very big piece of our business. So like repeat customers are, one, you have like great payment history from the customers. They come back, they may need additional capital. We want to be their lending source. We want like, that is like, we are seeking that long-term relationship with the customer, lifetime value. That is what we look to establish with our customers, so that they needn't go somewhere else to find working capital. They found their quote unquote bank with us.
Got it. Got it. We talked earlier about the current economic times with tariffs going on right now. You have businesses probably that are getting products overseas from China or different countries. How is that impacting the lending business right now?
So it hasn't impacted it yet,
Okay.
but we're anticipating. But we because these were announced, I don't know, month and a half ago. We think it's taking a little bit of time to kind of flow through the system, and like whether somebody is sourcing their goods from China or wherever they're getting their material from to make whatever they're making or sell whatever they sell. It hasn't flowed through yet. We anticipate it to kind of hit sometime, sort of middle of June to middle of July, that we're going to start to see a little bit of an impact. The reality is, I don't know what industry, we have an idea of what industries will be impacted, but I'm not sure that it's going to be based on the way that we profile the risk. So meaning that if we have A1, A2, and A3 band, and then we have Bs and Cs. I am pretty certain that we're going to see, deals that are A1, which is our like best credit quality customer, that it's going to get the best rate, that's going to like on paper look the best. There's going to be companies in that band that are going to be experiencing trouble, just because they're in a business that might be dependent on imports. And so it's not necessarily going to be like credit risk weighted, the impact, I think, from the tariffs. I think it's going to have like a sort of an effect in a very disparate way on the portfolio. So it's not necessarily concentrated into like any one band, which is going to make it like a little bit more challenging to identify where to tighten and potentially where to be a little bit looser from a lending perspective.
There's so many different questions that I have for you. I know we're almost at time. The fintech, the lending vertical is something that has been growing over the years. What are two pieces of advice you would give to people entering or businesses entering that space? because you're like a lending OG, man. You've been around from a fintech perspective. You've been around a minute,
Right.
15 years now.
Yeah. So, like any business, I think you need to, um, I would start slow, and evaluate like sort of the portfolio as you grow it. Like there's arguments that like now is the best time to start any business. Like anytime there's like a like sort of like economic tumult of some sort, that there's always people who say like today's the best day to start a business, like in COVID or whatever the case may be. It's probably a good time. Like I don't, I'm not an economist, so I don't know, but I think it's a much more complicated business than what it seems like. So, lending to small businesses, it might sound simple, like, oh my, like, hey, there's a bagel store, they make great bagels and they're super busy on Sundays and blah, blah, blah. Like we should lend that, and they need working capital. It's just like, but is the owner a big time gambler? Like, like if you look at their bank statements, you might say, like for example, like if DraftKings is coming out and like those are signs that our algorithm picks up. Like you see some people that are have DraftKings like it's coming out of their account 50 times a day. They're just like betting all day long. So you just don't know what you're getting into. And so that's the problem with small business lending is you have an entity that guards you, then you have like owners of that entity. So you have to do research on the entity, the validity of the entity, then you have to do research on the owners, and then you're also looking at the cash flow. So it's and there's so much like good data out there now and good signals, but finding the data that's predictive is the challenge. And that's where I think we have an advantage because we've been doing it for a while now, that we have all this data and signals that we can sort of see and anticipate what is going to happen. So, or we like to think we can. We can't always. We couldn't see the pandemic coming. So I'll tell you that. So,
I mean, and I think the biggest value when you start talking about AI and machine learning is like your internal data and the experience that you have that you can now leverage. That's not necessarily, public data. It's your internal, and that's really part of your intellectual property because now over being in the business for so long, you've seen all different scenarios that you can now plug in and have your models really take a look at to make different inferences. So makes sense.
that's exactly that's it in a nutshell. I mean, like we use all these like machine learning, large language models, like on what I'll call mundane sort of tasks that humans were like looking up or things like that we're now leveraging agents to do. But at the end of the day, then we have our own database, which is like the most, like everyone will say data is gold, like that is our gold. So we're leveraging like our data, our performance metrics, our performance, just everything about the information that we have, and then using that to make better decisions going forward. So because like all we try to do is make more yeses, or smarter no's, or whatever the case may be.
Make more yeses or smarter no's. I'm gonna take that from you, man. I like that. Listen, we have a tradition at the end of our show. We give the guest the platform to talk about your business, talk about how people can find you, and so forth. So I'm gonna step off stage and give you the opportunity to do that.
Great. So again, Ryan Rosett, company's Credibly, Credibly. You can go find us at credibly.com. Again, we have an online application process, and we're always looking for new customers, and I think you'll enjoy working with us.
And you back to the stage. Let me what I'll do is I'll put that, it's in the show notes, but what I also like to do is put it as part of the video as well. So let me do that right now.
We And I just will add one other thing while you're doing that. We just launched a site that just kind of showcases our AI efforts, and it's credibly.ai. So just it kind of gives you some of the sense of what we're doing on the artificial intelligence side.
Ben, thank you, Ryan.
Yeah, thanks, Ben.
Okay, let me see something. Have me some. Let me post this thing real quick. It's definitely been an interesting show. So what I like to say is, like, this is our first show. No, it's not. Well, I like to say this, in terms of lending and diving into it, I love the path that you took us through, 08 till now. And, we look at you as now one of our lending experts, especially to the small business sector. So, when something comes up in the news around that, I'm going to call upon you and say, listen, Ryan, you have some time, help the audience or help the public, understand what's going on. So a website Ryan mentioned is credibly.com. I put it as part of the video so you guys can take a look at it. It'll also be in the description of the show. For us, techbehindfintech.com. If you haven't yet done so, please go to the website and subscribe to our podcast, our newsletter, so you can be updated on all the guests that we have coming up. And we also give a weekly news articles on fintech, so you can keep your hand on the pulse of the industry. So once again, that's techbehindfintech.com/subscribe. We are live every week at 12 p.m. EST on Friday. So you can check us out on this platform, techbehindfintech.com, and we stream live on Facebook, LinkedIn, YouTube, and I also have a separate stream going from Instagram. Let me wave to my Instagram folks. All right, guys, it's been a wonderful show. Ryan, thank you very much for your time today. I really enjoyed it. Thanks for walking us down memory lane in terms of that 08 crisis. It's good to see that everyone survived it. Well, we survived it and came out on top. And so that was had me really thinking about that time period. I was doing all sorts of wild things. So on that note, to all, have a wonderful weekend. Thank you very much for your time. Thank you for supporting the show. Something I always say, whether you watch the show live, whether you're going to watch it tomorrow, watch it next year, I thank you for your viewership. I thank you for your support over the last 5 years of doing this, and I appreciate you guys. Take care, and we will be back next week. Cheers.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.